So we're gonna start this lecture today with um, overviewing of how to post journal entries uh, to the T accounts. So we have our journal entry, which is prepaying insurance for the whole period. So the debit is going to be prepaid insurance. That's an asset, a short-term asset. And then the credit is going to be cash. And that's because cash is decreasing and cash is an asset. So it's going to be a credit. And then we have both of our T accounts for both prepaid insurance and cash. And so 2,400 is going to go in the debit balance for prepaid insurance, and then the credit balance for cash, which is in the credit amount here. And then that's going to reduce our cash balance. Right here we have the running, and then so we have our debits, credits, and then a running balance, and it shows whether the running balance is a debit or a credit. So for prepaids, we have 2,400, and then our running balance is 2,400. And then for cash, it's initially 25,000. There's another journal entry here that's just not on the slide, but clearly reduced cash. And then the credit of 2,000 reduced it up to 5,900, and then 2,400 reduces the running balance from 5,900 to 3,500. And so we can see our running balance for the T account there. Transaction 2, net solutions paid rent for December of $800. So that's going to be a debit to rent expense for 800, and then a credit to cash or a credit to cash for 800 because it's reducing the cash. On the accounting equation, this reduces our assets and it reduces our owner's equity because it's an expense. For this entry, it's receiving cash for prepaid rent from people that are renting from the business. So the business receives cash, that's a debit to cash, and then the credit is to unearned rent, which is a liability because they owe the tenant 3 months of residence in the in the land. So this is 3 months rent beginning in December. Increases our assets and also increases the liability. And then purchasing of office equipment on account. Office equipment is going to be our debit because that's an asset that's going up. And then on account means that we didn't pay cash for this. We still owe the bill for the accounts payable. So accounts payable is going to go up, and that's a credit. Paid $150 for a newspaper advertisement. That's going to be a debit to an expense. In this case, it's going to be miscellaneous expense. If in the company's chart of accounts there was an advertising expense account, it could be advertising expense too. It just depends on how the company has their account set up. And then the debit or then the credit is going to be the cash because the cash is reduced. Net solutions paid creditors $400. So the accounts payable is going to go down. That's a debit because accounts payable is a liability. So when it goes down, the debit, and the cash is also going to go down, which is credit. Net paid exception for fees earned in the first half of December. And since it's in the first half of December, we know that they earned the revenue in the period. So the credit is going to be to fee earned, and then the is going to be cash is going up. If, for example, it counts because they did for the previous month billed to was the previous month new, but this month, you know, you have to record the revenue in the period in which it's earned, and so accounts receivable would have been recorded in December, and then in December, accounts receivable would decrease. But in this case, it's simple cash for revenue. Fees on account totaled 1,700 for the first half of December, so our accounts receivable is going to go up, and then fees earned is also going to go up, which is a credit. That's paid under to for on the $1,800. So 1,800 is not relevant to this problem because that's not amount included in this transaction. Only the 900 is relevant. So the 900 is going to reduce accounts payable, which is a debit, and then the credit is going to be the cash. And then Net Solutions collected $650 from customers on account. So the cash is going to be our debit, and then accounts receivable is going to be our credit because we're collecting cash from the customers, like we talked about before. Just want to check in on where we are right now. And then Net Solutions paid $1,450 for supplies. So supplies is our debit because it's an asset that's going up, and then cash is going to go down, and that's our credit. Net Solutions paid the part-time assistant for $1,200. So that's another one. Wage expense is the debit, and then cash is the credit. Utilities expense is the same story. So utilities expense is our debit, and cash is our credit because cash is going down. Another utilities expense with utilities as the debit, cash is the credit. Second half of December fees earned. So this is the same as the first half with fees earned, revenue as the credit, and then cash is the debit because they're receiving cash. Fees on account, and then the withdrawings. So remember, dividends reduce owner's equity, which is a right side amount. So that's going to be a debit, and then cash is our credit. So then all of the transactions that we just went over go into what's called a general ledger. And this is a list for each account of what has happened in this account over the period. You can see cash got used a lot because a lot of transactions impact cash, and then other accounts didn't get as many transactions, right? But they each have their own amount. There's also a running total that shows what the balance is. So right here we have a balance of cash at all the different points during the period, and then, supplies, right? So we have our initial purchasing of supplies and then the reduction of supplies during the period and then our ending. Um, these are more examples of all the transactions we had during the period. So you can see that, liabilities such as accounts payable have credit balances. The dividends or drawings have debit balance. The capital credit balance. Office equipment and land are assets, so they have a debit balance. And then these are our income statement accounts. We have our fees earned, which is a credit balance, and then wages expense, supplies expense. These will be in the blank sheets for this for the homework this week is you know, filling out the journal entries and then posting the journal entries to a general ledger like this. In the days when accounting was done on paper, this is how it was done, is they would have this massive book and they would post each of the entries in the journal ledger into the general ledger and total up as they went. Um, Now it's all done by computers, but the reports are still generated by the accounting software so that people can use these and see, well, what was the balance throughout the period and what were the transactions that impacted each account. Um, so which of the following processes is transferring debits and credits from journal entries into the general ledger? Posting, exactly. So Quick Fix Company purchased 2,250 in supplies on account. Journalize the entry, prepare a 4-column account, prepare the accounts payable account, and then post the account. So the journal entry is going to be a debit to supplies and a credits to accounts payable. They gave us the beginning balance of supplies at 400, right? So we have the date, item, debit, credit, and then our balance. So the balance started at 400. We add 2250. And then for accounts payable, it started at 18,300, and then they now owe another 2,000. So the balance is going to increase. And then the posting of it is um, you have journal page 73 at the top, and then the 73 posting reference goes to the page so you can refer back. And then the account number 15 and account number 21, that goes in the the posting reference column on the journal entry, so it says what account it points to exactly. And in an accounting software, you would have a record number or a transaction number, and it would be a really long series because you have a lot of transactions. Transactions in T accounts, the following transactions were occurred in the following year. So create the journal entries and post them. We're going to have our fees earned, supplies purchased, cash collected from customers, and then the cash paid to suppliers are our 4 journal entries here. And then we can post them to our T accounts. This is another form of posting to a general ledger. This is also a simpler form of creating a general ledger. And this is this is also what it could look like on the homework. And this is more commonly what's used in like teaching accounting because it's simpler. You don't have to fill out all of these items. Like that's insane, right? So T accounts simplify the process, right? We have our transaction number. So the first journal entry was revenue, so that increases accounts receivable, increases the fees earned. Accounts payable and supplies was our second, and then, right, so each entry has its reference, and the debits and credits go on the right side and the left side of the T account. During the month, they received one $1,245,000 in cash, and then they paid out $974,000 in cash. Does this indicate that they had 270,000 in net income? And if the balance of cash is 421,000 at the month end, what was the cash at the beginning of the month? So remember, the amount of cash that the business increases or decreases, that doesn't actually reflect what net income is, right? Because we've been going over throughout like the lecture today, there are a lot of expense records that don't relate to cash paid or received. You know, uh, uh, purchasing things on account, paying customers on account, or paying suppliers on account, going over the end of the accounting period, but payday for your employees isn't until afterwards. So there are a lot of non-cash expenses for the period, but that we have to recognize during the period. And so that's why net income doesn't necessarily mean like that's the amount of cash that a business made or lost. And then the beginning cash is 421,000. So the ending cash would be 270,000. 270, 800 plus 421 would be 600 and 91,000. Right? Because we can have our T account and then add, and then work backwards to the beginning balance. Oh, the balance of cash is 421 at the end of the month, at the beginning of the month. But anyways, I read that wrong. Um, I think we can skip doing another example of this because I want to get to the amounts on the trial balance, right? So this is our you can determine the beginning balances of these accounts by adding and subtracting. And so this is important because the credits on the right side, like this will increase your total credits. And then you determine, you know, you subtract your debits from your credits in this example, and then that would get to your ending balance. You know, and we can also determine we had a beginning accounts receivable of 115,000, and then customers paid 449,000. So that, right, that's more than the initial balance. So we can tell that if we take the 115 minus 100, this isn't how it makes sense in my brain to do this. But basically I would take the 115,000 minus the 449, and you would get negative 333,000, and then I would subtract another 137,700 by the end, right? And then you have like you have a negative 464,000, and that's the same as the 464,570. So it's just you know that that's what it would have to be in order to get your ending balance of 130,000 is to have this 464 in the middle there. Because to get to your ending balance, you take 115 plus the 464 minus the 449, and you get the 130. Does anyone have any questions about this? Okay. So the trial balance is just a list of all of the accounts and their ending balances at the end of the period. And then so and whether the balance is a debit or a credit. It's always going to balance. Um, if there are no errors, it will always balance because your debits always equal your credits and the sides of your accounting equation are in balance. Um, especially in like electronic software, it's always going to balance, but we also have like the human element where maybe a debit or a credit is unbalanced, missing, not posted to an account. This is one way that you can find errors and verify that your debits and credits are equal. So the name of the company, the date of the trial balance is at the top, and then the total debit and credit balances are the same, and each account is listed out. And then you can verify that the total debits and credits are the same and that the accounts like all add up and footing is adding up all of the amounts and verifying that that's the total at the bottom. That's called footing. You have to verify that it foots. So we have all of our debits, which are our assets, and then the drawings, and then our expenses, and then our credits are our liabilities, owner's equity, and revenue. So if the totals are not equal, there is an error, and you know that there's an error. However, it doesn't guarantee if they balance that there are no errors. There still could be an error that doesn't put debits and credits out of balance. So, for example, if you missed a transaction during the period, you missed both the debit and the credit, there would still be an error even though your trial balance is still in balance. Um, also, if you put the debit to the wrong account, your debits and credits would still be in balance, right? So it only indicates that debits and credits are equal. Um, and so we're going to go over some correcting journal entries to correct errors that could occur. So this example is the purchase of office equipment for cash was incorrectly posted as a debit to supplies instead of as a debit to office equipment. So the error that was the journal entry that was made was a debit to supplies, credit to cash, and the one that should have been made was a debit to office equipment and a credit to cash. So to correct this, there's two ways that you could correct it. One way would be reversing completely and then making the other journal entry, like the correct journal entry again. So if you made a credit to supplies, debit to cash of the same amount, and that would reverse out this journal entry. But a simpler way to correct it is just to debit office supplies and credit supplies. This makes our balances correct because we're reducing supplies by the amount it was increased before, and then we're increasing office equipment. So it just it corrects the balance. So determine the net income or loss from the trial balance. The accounts will be ordered in the order that they appear on the financial statements, starting with the balance sheet. So you'll have your assets first, then your liabilities, then your owner's equity, then your revenue, and your expenses. So to calculate the net income, you take revenue minus expenses, and you get your net income of 12,125. For this one, is prepare an unadjusted trial balance of all the accounts, and then you can determine the cash amount because you need the statements to balance. So in this, if you created your trial balance and you had all of your natural debit accounts on one side, your debits and your credits are all there, and you know that your assets are going to be a debit, your expenses are going to be a debit, your liabilities are going to be a credit, right? You have it all laid out and written down on your trial balance, and then you add them all up, and your cash amount is missing, and you can know the amount needed to plug because your debits are going to be less because you're missing your cash amount. So the amount that your debits are less than your credits will be the cash balance. Is this? So in this case here, the cash is 426,800 because that is the amount. If you omitted it, right, that's what makes it balance both to 6.5 million. Errors in the trial balance. So this trial balance has a number of errors with it. First of all, if you add up all of these debit balances, it does not add up to 273,000, I believe. Also, debits are way less than credits here. Another few things that jump out just off the top of my head is, right, wages expense is listed as a credit when it should be listed as a debit. Advertising expense is listed as a credit, not a debit. So when you're looking in your homework or on a quiz and you're like, what's wrong with it? Just look at all the accounts and make sure that they're on the right side. So for this one, why isn't this? Okay. So, right, after it's been corrected, the wages expense is on right, we correct the wages expense, correct the miscellaneous expense. A billing of $9,000 to a customer on account was not posted to accounts receivable, which means our accounts receivable is too low. So we have to add $9,000 to that amount. So you can see accounts receivable is 46,000 instead of the 37,000 that it is on this slide. And then a payment of 4,500 made to a credit on account was not posted to accounts payable. So our accounts payable is too low on this trial balance. So there will be a problem, right, where it just gives you a trial balance like this and lists a whole bunch of errors that were made, and then you have to make the additions or subtractions as necessary to the amounts, and then make sure that it balances. So that's going to be a key thing is when you're submitting a trial balance problem on the homework, make sure your debits and credits balance because it has to balance in order for it to be correct. So the following errors occurred in posting from a 2-column journal. So a credit of $6,000 to accounts payable was not posted. If no other errors had occurred, will each of these be impacting the total debits and credits out of balance? And then will the assets be greater, or will the debits be greater, or will the credits be greater because of it? So for this first one, a credit of accounts payable isn't posted. That is gonna, there are now going to be less credits than debits. So it is going to throw it out of balance. And now the debits are going to be greater. An entry debiting accounts receivable and crediting fees earned was not posted. This is not going to impact it because, right, you missed both sides of the journal entry. A debit of 2,700 was not posted, or no, was posted as a credit. So this is going to impact it, and the impact is actually going to be double the amount. So it's going to be a 5,400 more debits than credits. And then a debit to $480 to supplies was posted twice. So the debits are going to be greater. Debit to cash was posted to miscellaneous expense. That's not going to impact it because the debit was still posted. It was just posted to the wrong account. So there's going to be no impact there. Credit to cash was posted to the wrong amount. That is going to impact it because it was the wrong amount of debit without an offsetting credit was posted. Or credit in this case, so the credits are going to be greater. And then a debit of 12,000 to wages expense was posted to the wrong amount. So once again, this is going to make our credits greater, but it was the wrong amount. So this trial balance, identify errors in this trial balance. So right, it balances, but there are still clear errors in this trial balance. One is that the debit balances don't correctly add up. Another is that so it should be, if you actually add up all of these, it's only 1,098,000. So they're over $700,000 short on debits than credits in this trial balance. Additionally, it's not for the year ending, it's as of December 31st. The trial balance is a snapshot in time. It's as of the end of the period. This is what the account balances were. Accounts receivable is a debit, not a credit. The drawing account, the accounts payable should be as a credit, right? The drawing account should be a debit, and the advertising expense should be a debit. And then once we, add things up correctly and shift the accounts to where they need to be, then it does balance properly at 1.45 million. Now we're going to go over some more entries to correct errors. Insurance paid for the year was recorded as a debit to insurance expense, but and a credit to prepaid insurance. However, it should have been recorded as prepaid insurance cash because this entry wasn't intended to be the expense entry, it was the prepayment entry. So we have to increase our prepaid insurance to where it should be at 12,000, decrease the insurance expense because we shouldn't have insurance expense from this entry. So the net effect is now 0 from both of these entries being made because we increased it, then we decreased it. And then prepaid insurance has to go up to be in line with what it actually should be, and then cash has to go down. So in this case, because insurance expense was a account that never should have been in this entry, right? And prepaid insurance was a credit and not a debit. We have to reverse the whole entry. Like there's no correcting it with just a single 2-account entry to correct a single account. Withdrawals were recorded as a debit to wages expense and a credit to cash instead of a drawing account. So in this case, we can have 2 journal entries to reverse it out, right? But we don't actually need 2 journal entries to cancel it out because cash is a debit and a credit here, and that cancels out. We could have just had a debit to dividend to drawing account and then a credit to wages expense, to reduce the wages expense that we shouldn't have recorded, but this is still a valid answer. You can still have two correcting journal entries and arrive at the same balance that you would have. Cash of $77,550 was received on account and recorded as a debit to fees earned, credit to cash. So this should have been, right? The entry that was made was a debit to fees earned and then a credit to cash. What's the entry that should have been made? Yep. So for the correcting entry, we'll have to put accounts receivable. And it would accounts receivable been a debit or a credit? So it would have been a credit because they received the cash. So that reduces the accounts receivable. So the debit was would be the cash, and then AR would be the credit. And since this will be in our, in our correcting entry here, right? Because we have to make the correct entry and then we'll reverse out the old entry. So that'll be cash as our debit, because we have to reverse in the initial wrong entry, cash was reduced by 7,550. So we have to increase it by 7,550, but that would make the net impact 0. So we still have to have another 7,550 in debits to cash, and then yep, fees earned. I'm at the end of my rope here, but you guys get the idea. So and then, for B, so, fees earned, we have to reverse it out. And then for the next entry, supplies expense was initially recorded as a debit to supplies expense and credit to accounts payable, but in fact, it was to cash. So, right, we have to reverse our entry by having a credit to supplies expense, debit to accounts payable, and then make the correct entry of a debit to supplies and a credit to cash. We're going to talk a little bit now about horizontal analysis of financial statements, and that is comparing from different years or different periods, different years, different quarters, different months. How has the same account changed on the financial statements? So a lot of times it'll be net income. How has net income increased? What's been the percentage of the increase? And then could also be balance sheet accounts. So how has cash increased throughout the year? And there's two key things about this. One is that it has to be the same account. So it has to be comparing between the same statements and the same account for it to be a horizontal analysis. You have to compare apples to apples. And then when you're comparing the two statements, the percentage of the change is based off of the earlier statement. So if last year was 100 and this year it's 125, that would be a 25% increase, because the 25 of increase is divided by the earlier statement's balance to calculate. For example, here in this income statement, we have our fees earned in the first year, which was 2026, 150,000, and then it increased 37,000 to 187. That's a 25% increase because the 37,000 is divided by the initial 150,000. And this is useful for figuring out not only what's the trend happening in the business, which is the company's increasing net income, but where did the increase come from? They had a bunch more revenue. They had some additional expenses, and then some expenses decreased. But overall, the revenue increased 25%, the expenses increased 30%, and so their net income increased 19%. And that's just useful for looking at a business from management's perspective, right? So which of the following comparisons would be appropriate use of the horizontal analysis? So current year balance sheet to prior year balance sheet. That would be appropriate. But income statement to last year's balance sheet, that would not be because it's not the same accounts. And then it has to be the same statement and the same accounts that you're comparing. So that's the end of the chapter 2 lecture. I do have um, the financials from the last week. I was showing you guys how to look up the financials of companies. So I thought we would do some horizontal analysis on Amazon. If you just, once again, if you just look up a company and then 10K or SEC filings, you'll be able to find the investor relations page of a public company, and you can just select annual filings, quarterly filings, and that'll bring up the financials. So this is Amazon's income statement. And then they also have Excel versions of each of these as well. So if you download the Excel ones, you can have an Excel of all the tables, and it makes it a lot easier to do this kind of analysis. So right, to compare between 2024 and 2023, we can subtract and then calculate the percentage by dividing the increase by last year's amount. And then we go all the way down. You can see how things change throughout the year. So, Amazon's revenue increased by 6%, and then their they have product sales increased by 6% and service sales increased by 14% for a total of 10%. And then all of their individual expense types are listed out. So they have costs for fulfillment, which is the shipping from Amazon, the ordering things online. And then they also have technology and infrastructure. That's Amazon's AWS business, which is their new growing market for data centers. So it's just a useful way to analyze where are the increases and decreases really happening. Do you guys have any questions about the chapter this week? Anything you'd like me to go over? Any other companies you want to take a look at? Oh, sure. Yeah, let's take a look at the balance sheet. So in here, there's a lot of tables because this is all of the tables from a big, it's like a 200-page financial report, so that every table is going to be in there. So this should be the balance sheet here. So you can see they have their cash. We can do a quick comparison here. All these accounts. They have about, so it says all of these amounts are in millions, except the per share data. So the cash is at 78 billion and went up by 7%. You know, and it's important to, hey, we can get our formatting right. So the cash went up by 7%. Looks like their marketable securities went up by 67% though. That's interesting, right? Maybe they were putting more of their cash into the short-term financial securities to take advantage of, like, interest rates are higher now, so they can get more money on commercial paper or things like that than just holding it in cash. Um, Another interesting thing, their unearned revenue increased quite a bit, 18%. So that's probably means customers are prepaying a lot more for Amazon services, whether it's Prime. If Amazon receives a year of Prime membership in advance, that would go to unearned revenue. If they get a year of Amazon Web Service data contract in advance, that would go into unearned revenue. This is, horizontal analysis like this is really important in analyzing what changed throughout the year, what's the story there, but also looking for anomalies and thinking, what do we need to focus on if you're auditing a business? And look at this. What jumps out to me, the marketable securities increased 67%. That means you're going to have to test more marketable securities audit testing. If the goodwill increased by 46%, goodwill is the um, intangible, it's an intangible asset that's created when you acquire a business for more, when Amazon buys a business for more than the value of that business assets are worth. The extra value there in the business acquisition gets recorded as goodwill because that's like basically the brand value when you're acquiring a business. It's the, I'll like, a business is worth more than the sum of its parts, right? If you just liquidated a business, you probably wouldn't get as much for selling all the assets and then paying back the liabilities is what it's worth. Um, so that's where that gets recorded. And then if you're looking at this as an auditor, you'd think, okay, they acquired a lot of businesses this year, and you're going to have to test, was it really worth what they paid for it? Is the goodwill of the company, is that business acquisition still worth a lot of money, or are you going to have like write it off? Um, yeah. Let's see. What's this 23% increase? That's property and equipment. So that means that Amazon was purchasing a lot of property and equipment this year, whether it's data warehouse server stuff like graphics cards um, or other things like that, right? And then when you find this, when you're looking at a financial statement and you find out, okay, their property and equipment increased a lot this year, you can think, why did it increase so much? And that's when we get into the notes of the financial statements. So each, if you just scroll down from the financials on any of these reports, you're going to get into the notes. So the first note is always on their accounting methods. And then you get into each and every one of the, like, the descriptions of all the line items in the financials, right? So when we were looking at the expenses, they have fulfillment, technology and infrastructure, sales and marketing, and then they have a paragraph on each describing what goes into each of these line items. And you can learn a lot about the business by reading these reports. So for property and equipment, This just talks about their accounting methods over it. Maybe in the financial, maybe elsewhere, it would describe what they purchased this year. Um, oh, here we go. They talk about free cash flow here, but actually, if we just looked on the financial statements at the cash flows section, hmm, we would see that purchases of property, plant, and equipment were $63 billion by Amazon this year. So, like, that's sort of the analysis and the investigation that you can do when you're going into these horizontal analysis problems. Is there anything else you guys are curious about? Sure. So this is the cash flow statement here. It doesn't look as pretty um, as if we'll just go on the annual report. So, so this is their cash flow statement. And there's a lot going on here. This is also a different method of presentation than what you guys prepared in the homework last week. Last week, you guys did what was called the direct method, and that's mostly relating to the operating activities section. What you guys did was the direct method, which is you write out cash received from customers as an increase to cash, and then cash paid out for expenses, that's your decrease to cash, and then you have your cash flows from operations. That's simple enough when you just have an accounting equation grid and it's all sort of laid out. It's an absolute nightmare for a big company like Amazon um, to do something like that. So this method is used instead, which is you start with net income and then you add and subtract all of the cash and non-cash items. So they take out um, depreciation. Depreciation is a non-cash expense. It's reducing the value of your property, plant, and equipment over the life of using the asset. Stock-based compensation is non-cash because the company just issues stock to pay their executives, but that's still an expense of the business because it reduces the ownership stake for all the existing owners of the business. Um, non-operating non-operating expenses, right? So net income to get to operating cash flows, you have your net income, but then you have to take out the net income that was not operating income because only operating income would be in the operating cash flows section. And then changes to operating assets, that's another way to figure out what was cash and what wasn't cash expenses of the business. So if they purchased more inventory, that would be an operating cash flow, but that isn't going to appear in net income because they haven't sold the inventory yet. So changes in inventory, changes in accounts receivable, accounts payable, other short-term assets, those changes are going to be reflected here. And then you get so they had an insane 115 billion in operating cash flow this year. And then it went to their investing section, was 82 billion in property purchases. Purchases of marketable securities. We saw that on the balance sheet, that they increased that by about 26 billion. Um, and then also sales of and maturities of marketable securities. That's another, so there's it flows in and out from those investing activities, because when you get income or when you get cash by selling an investment, that goes to your investing activities as well. And then financing, um, they paid back a small amount of short-term and long-term debt, but really it's nothing compared to their operating cash flows. So what's the story from this? They're getting a whole bunch of cash from operations and they're investing it back into the business, and they're really not borrowing a lot of cash. And that kind of makes sense from Amazon's business strategy. They have a lot of cash, they have a lot of cash flow to invest back in the business, and they don't really need to borrow, especially when interest rates are as high as they are right now. So fun stuff. As you can tell, I just like to read these as I go to bed at night, right? Um, and then we may as well look at the equity statement as well. So they didn't have a lot of financing activities, so there's not going to be a lot on the statement of equity. Um, the stuff that happened in 2024, which is the most recent full year, would be in the bottom section because they display it, going from top to bottom, 2022, 2023, 2024. Um, it's like they had some minor stock-based compensation, and then their net income, and they didn't, they in the past they had common stock repurchased, but in the past 2 years they haven't done any stock buybacks. They've just been reinvesting the cash in the business. They don't, doesn't look like they have any dividends. Um, this is about as simple as it gets for a statement of equity. They just have their net income, and then they have the a minor amount of stock-based compensation. Um, any other questions? Companies, statements. There'll be more, we can always do more of this in other weeks. Yeah, well, thank you guys.